Welcome to HYCM Insight with myself, Giles Coughlin, a Chief Currency Analyst. The market mood for the session ahead is as follows. Now, the Canadian dollar has been strongly supported over the last period of time after a very bullish shift from the Bank of Canada. The Canadian dollar has risen by its most since June 2020 against the US dollar, and the Bank of Canada is now the first central bank to exit its stimulus program after it announced that asset purchases would be reduced from $4 billion a week down to $3 billion a week. On top of this, the Bank of Canada also brought forward its guidance, expecting an interest rate rise now in 2022 rather than an interest rise that was previously expected in 2023. This is supportive for the CAD. The US dollar, by contrast, is weak at the moment as US 10-year yields have kept falling and they failed to rise despite a really good run of data. And there's been a stronger than expected US CPI, US retail sales, non-farm payrolls data, PMI manufacturing, PMI services data, all of it showing strength. And yet, if you just take a quick look now at the US 10-year yields, you can see that the US 10-year yields, despite this good run of data, has continued to be falling. That's the orange line on the chart. As a consequence, many analysts are expecting further US dollar weakness over the medium term. So in these conditions, it's reasonable to expect US dollar Canadian dollar sellers on rallies. 1.2540 to 1.2560 would be an ideal region to go short. It's also possible for traders to go short at market with stops just riding above the 1.2660 region, looking for a move down to that 1.2400 region. This outlook is not without risks. The key trade risk is any further rise in Canadian COVID-19 cases. That will put strain on the Canadian dollar's bullish outlook. Look, any sharp falls in the oil markets on rising COVID-19 cases will also weaken CAD. And if the FOMC meet next week and announce bond tapering, that will support the US dollar too and invalidate this outlook.